Welcome to App Talk with Upptic, where we dig into the nitty-gritty of how to grow apps and games. We speak with industry experts about specific strategies, tools, and tactics they use to find success, and we keep you up to date with emerging news and trends in the ever-changing games, marketing, and technology ecosystem. My name is Xander, Director of Marketing here at Upptic, and joining me today is
Warren Woodward, co-founder of Upptic.
And that's it. We're doing a big tech earnings podcast. We have some news also at the top, but we just wanted, there's so much going on, and we've been covering big tech earnings and game earnings for basically a year now. And we figured these are there's so much to cover here. It makes sense to just make their own episode instead of trying to squeeze it in with an interview.
Everything's crazy right now. Yeah, we just wanted to do like a big news week this week. I mean, what's going on? It's Wednesday here, November 9th, as we record this. Midterms are wrapping up, getting the results from that. The crypto market is on fire again, though we thought it was already burned down, apparently can burn down further. So we'll get into what's driving that, and tons of crazy movements with the big tech companies, and you know that we're seeing the macro impacts all around. So it's going to be news, but I think it's going to be a spicy one today.
Yeah, there's some really spicy news at the top, and then we talked about crypto crashing. If you look at any tech company's stock chart, also down and to the right. So yeah, everyone's getting taken out back to behind the woodshed. Cool. So we got some really spicy stuff at the top. Warren, you want to kick us off?
Yeah. So, over the last 24 hours or so, the big news in crypto that's been having wide-reaching impacts is the kind of out of nowhere sudden demise of FTX, which is arguably the single largest power player in the blockchain and crypto space. Like, between what they own, the investments that they have, I mean, I think there's an FTX arena somewhere. If I followed sports more closely, I would know that for sure. So what's going on? So we're going to link to a tweet from CZ, who is the CEO of FTX's biggest competitor, Binance. So his tweet, and this is the high level, and then we'll go into details. This is from yesterday. CZ says, "This afternoon, FTX asked us for help. There is a significant liquidity crunch. To protect users, we signed a non-binding LOI intending to fully acquire FTX.com and help cover the liquidity crunch. We will be conducting a full DD in the coming days." All right, so this is from out of nowhere. So what happened here? So I'm going to kind of give cliff notes, assembling data from and some of these items from different news sources, different tweet threads. So grain of salt, there may be more clarity around some of these, but this is kind of our current understanding of the situation. So, FTX grew into prominence, really taking over all of things crypto and blockchain over the last, call it 24 months. And Binance was actually the largest early investor in FTX. I think they were the sole investor in their strategic round, if I am correct. It was either their first or second round, but essentially like the first major raise. Since then, they've actually become each other's main competitors. And in particular, in the last week or two, there's been very public fighting over Twitter between Sam Bankman-Fried, the CEO of FTX, and CZ, the CEO and founder of Binance. So this all came to a head over the last 24 to 48 hours, and this is kind of the series of events. So there's this fighting across Twitter between them. CZ of Binance then publicly announces that Binance will be selling all of their the FTT token, which is essentially the token associated with FTX. And he announces that Binance will be doing this because of liquidity concerns of FTX. Now, over on the FTX side, it becomes clear that around 8 billion of FTX's assets on hand are in its own token. So,
dangerous.
It's very dangerous. So it's the token that they essentially, print out of thin air. I mean, obviously it's tied to some public tokenomics, but, they create the source of 8 billion of their assets on hand. So CZ makes this announcement that their largest competitor is and their big investor is selling all of their token. This immediately crashes FTX's token price which
Right.
causes the liquidity crisis that CZ referred to. And this starts a crazy bank run of FTX's customers rapidly removing their funds from FTX, from the exchange. And FTX is now in a situation, because so many of their assets were in their own token, which has now collapsed, where they are now insolvent and
Right.
can't honor all of these users' withdrawals. This is our understanding.
Right.
And so now they need a bailout. So who comes to bail them out? CZ from Binance. So CZ, shares the tweet that we read, and he, clarifies that like he's reaching out and offering this full acquisition of FTX, which is now distressed because of the actions that CZ caused. So like CZ wins this public war in the most Chad way possible. And the irony of it is this is similar to at least accusations of some things that people have said FTX has done for some of the companies that they've acquired.
Right.
So there's a lot going on, but we wanted to walk through sort of like the step-by-step of how this happened and how it happened so rapidly. Xander, what do you think of this epic tale of crypto warfare?
I have, I don't know. I'm not following this as closely as you are. I do have some thoughts, but I have a question first. You said they were fighting on Twitter. Like, what is the nature of that fighting? What does that entail?
This would be another breakout topic, but we've mentioned this before. Sam Bankman-Fried of FTX, he's very politically involved. So
Right.
he's one of the largest contributors in the blockchain space to politicians. And he was working on a public bill, or basically a new set of laws that he was the driving force behind. That there was a lot of accusations that those laws were going to be driving practices that would be directly to the detriment of both his competitors and of DeFi. And so this is when the public fighting between Binance and FTX, at least I started seeing more of it happening on Twitter. That was sort of like the first step of this, was related to this new regulatory framework that was being proposed.
Yeah, this is interesting. I mean, Binance is an interesting company, right? Because they basically started as completely decentralized. They didn't have a headquarters or anything, and they sort of came out of nowhere to be the biggest exchange in the world without having centralized headquarters. And they basically were ungovernable because they were not incorporated in any jurisdiction. That has since changed, right? They are now trying to roll out and have rolled out in many, many different distinct jurisdictions. And from my understanding, they are the largest exchange in the world, even compared to FTX, and that is obviously true now. My one question is, like, isn't what happened to FTX basically the exact same thing that happened to Celsius? They were using crypto assets that they printed as underlying collateral for tradings and derivatives, and then as the faith in the asset tanks, it reduces the value of the underlying asset and creates a death spiral. Is there something functionally different between this and Celsius, or to me it looks exactly the same? So just
this rhymes with a lot of the other liquidity issues that we've seen, affecting this death spiral that crypto has been in over 2022, where there's a dependency on a native token for one of these entities. Right. It gets either, I don't want to say exploited, but basically there's some sort of either financial or social engineering that causes the collapse of it. And then there's, the domino effect leading to the downfall of the business.
Right. And, if we look at the crypto assets that have not had this effect, that have had longevity, it's the ones that are basically agnostic and traded across, Ethereum and Bitcoin being the obvious ones, although they still are depressed in a lot of ways. But there's no single point of failure in the same way they are for people like Celsius or people like now FTX, which makes a lot of sense and is basically incentive to the danger of having your own token.
Yeah, that's a big, as much as we talk about Web3, like for transparency, I own almost no crypto. And
I have a handful, but it's like 5%.
It's trivial. And it's, a lot of our interest in it is more for, but it's cliche, but like, what does the technology bring to the gaming space?
Right.
And one thing that's becoming clear is like, if it's, like Ethereum, like the best analogy I've heard is like it's oil. Like you need to use it to do stuff. Like there's so many tokens produced by different entities that are essentially some version of governance token, but to put more bluntly, like essentially like a shit coin. You know, it's
Right.
a token produced by the entity that has some sort of cooked up function or some sort of value in their ecosystem, but doesn't have a real world like practical use case in the way that Ethereum does, which is really the only, you know, that and maybe some other you know, tokens that power their own chains or side chains like Matic for Polygon. I mean, those are the only things that I have much faith in personally in the current market conditions. Is like, you know, does it actually let you do a thing that you need to do in the ecosystem? But I know we have a lot to cover today, Xander. Any parting thoughts on this, or do you want to go on to the other big news announcement this week?
No, I mean, this basically falls in line with everything we've been seeing so far in the
Yeah.
ecosystem. It is surprising to see a company as big and, you know, hegemonic as FTX collapsing so quickly.
Yeah, and there's far-reaching impacts. I mean, I've already talked to friends who, you know, were building their businesses on planned investments from FTX that are basically
Yikes.
like looking for jobs now. So we'll see how this
Bummer.
lands, but it's a scary time if you know, are a Web3 native business closely tied to FTX.
Yeah, I guess there's
Oh,
one other thing, which is I used BlockFi to
mhm.
hold some of my crypto assets. Actually, basically all of them that aren't like in NFTs, and they're owned by FTX. And so I'm hoping that that doesn't disappear overnight because that'd be a bummer. All right.
Definitely.
Anyway,
Yeah, we'll
next
have
up.
more on that a little later. So the other thing we want to touch on, this is a follow-up to, you know, something we've been covering, is that the Unity and ironSource merger is complete. So this is from an email that came out directly from ironSource, and we're just going to read the full announcement real quick. So we've been covering this for, you know, last couple of months since these explorations started. Okay, so here's the email. Today, ironSource merged with Unity, the world's leading platform for creating and operating 2D and real-time 3D content. This is an exciting day for our team as well as our partners. We believe that ironSource and Unity are better together. As one company, we will provide the most comprehensive and compelling offering for app and game developers on the market today, supporting our partners across the entire development lifecycle. We'll be able to execute on our mission to turn apps into successful businesses with opportunities to deliver even more value for our partners. I'm going to skip a little bit of this. We believe that advertiser partners will benefit from the powerful synergies between Unity and ironSource, with deeper connections between Unity and Level Play, creating a complete growth loop to drive better user acquisition. More importantly, we'll continue to invest in deepening our product to provide the most robust end-to-end platform in the market to power your growth. As we further integrate our technology, you can expect it to be business as usual, and we will continue to work with you as we always have. The relationship we build with you has been and remains at the center of everything both ironSource and Unity do. All right, so this has potentially huge implications for the mobile gaming ecosystem where we spend a lot of our core work. Xander, I know we've been talking about this deal for a while. It's actually closed. What do you think the impact is going to be for our segment?
Yeah, I mean, and props to Unity for getting this done. This is probably, you know, I talked about how I thought maybe an Apple-Lin merger would be a better strategic move, but with ruling that out, Unity is effectively now the most powerful, you know, publishing tool or stack of publishing tools in the mobile games and mobile marketing ecosystem. They already controlled the development process with the Unity platform, Unity development platform, and now they're able to layer in all the monetization tools of ironSource into that existing workflow. ironSource has a very good account management team, which Unity has always lacked, so they get an incremental go-to-market resource there. And I think this, you know, really bodes well for the long term for this company. I mean, these stocks are both abolished, like completely demolished. But as far as consolidating power during a downturn, if there's anyone who's going to be able to succeed on a go-forward basis, it's this combined entity. It's like them or Apple, but honestly, because they control the development process, they have an advantage that Apple doesn't have. And so, you know, I think you'd be really dangerous to sleep on this combined entity.
Yeah, and you know, just thinking ahead, next week we have Raphael
Mm.
from AppLovin, who is like a day one employee there. He's leading on a lot of their Web3 initiatives. I think it'll be interesting to get some of his take on how AppLovin's, you know, M&A strategy and growth strategy over the last couple of years is, you know, comparing and contrasting that to ironSource and Unity here. The thing that I want to draw attention to, which I said before, which I think is like the low hanging fruit and like immediate impact or near-term impact of this, is Unity's edge. As you said, Xander, they've never had the best BD team. They've
Right.
never had the best, you know, user-facing product for those of us in user acquisition. But their edge is that they're by default in such a large, their SDK is already in such a large percentage of all mobile games.
Right.
And so it's had the lowest barrier of entry for most developers to serve ads in their game. It's already there. So if you can take that and then merge it with ironSource as a leading mediation platform, if you can essentially flip a switch and have a mediation provider, that's going to really make it difficult for AppLovin and other mediation providers, because it's always harder to rip something out and replace once there's already something there. So if this means that a huge percentage of mobile games already have a default MMP integrated when they integrate the Unity SDK, that is a huge edge for the Unity plus ironSource entity.
Yeah. Mediation platform. Yeah. But yeah. Yeah, that's totally a good point. I mean, you bet against AppLovin at your own risk. They've done well so far. That being said, there isn't really another Unity. The closest thing is like maybe Unreal Engine, but they're not mobile focused. They don't really, I think Unity owns like about 90% of the development market for mobile. And so like AppLovin doesn't really have anywhere else to go in terms of getting that last layer of verticalization in their stack of their business stack. And so, over time, it seems like Unity has an inherent competitive edge. This combined entity has an inherent competitive edge that unless AppLovin is able to drive immense value somewhere else in the value chain, I'm not really sure how over the longer of history they compete, despite the fact that they've done incredibly well to date.
Let's see. I mean, again, we're looking ahead to our future conversation, but if, say, AppLovin makes the play of if Web3 gaming grows like, we kind of have a thesis it will, and AppLovin is early to market for the SDK that you integrate to add a Web3 layer to your mobile game, and that's bundled with their Max Ads mediation product, that could be their in. It's coming from a different angle, but this will be really interesting to explore with AppLovin next week.
But here's the flip side of that is, let's say that happens. Let's say over 2 to 3 years, they dominate Web3 space. In 2 to 3 years, Unity then provides a platform that does the same thing and bundles it with the Unity development platform. Over the long arc, they're going to do the same thing that they just did to mediation because they own the relationship with the developer. So I'm just saying, like, you could be right, but it's a scary time. I mean, I own AppLovin stock. We've talked about this in the past. It's just a scary time, and I hold it. I'm not selling it, but it's a scary time to be AppLovin or anyone else really in the value chain.
Yeah, what a wild year. Yeah. Awesome. Well, let's get into our main topic. This is always one of my favorite episodes where I just kind of sit back and listen, which is like our earnings deep dive with Xander. So let's get into it. Where do you want to start?
Well, we have a bunch to cover. I'll try and be as coherent as possible. It's a lot of data, and I just want to through it without getting everyone's eyes to glaze over. So the first we're going to cover is Meta. You might have heard of them. They own Facebook. Here's a short quote from their Q3 earnings report. Quote, while we face a near-term challenge on revenue, fundamentals are there for a return to stronger revenue growth. We are approaching 2023 with a focus on prioritization and efficiency that will help us navigate the current environment and emerge an even stronger company. That is a very kind way of describing their fundamentals. So in terms of their profitability, they were profitable, but anyway, quarterly revenue was down 4% year over year to 28 billion. The cost and expenditures were up 19% to 22 billion, and headcount was up 28% to 87,000. Overall, net income was down 49% to 4.3 billion. So we'll get back to that in a second, but netting out, they're making 5 billion less year over year than they did the same time last year. So that's not great. It's not even good. It's bad. Yikes. So some interesting stuff on the product metrics. They really emphasize this in their earnings letter, but it is a little bit fluffy. So DAP, daily active people, which is their DAU count across the family of apps, was up 4% year over year to nearly 3 billion, while the Facebook DAU is up 3% year over year to nearly 2 billion. One thing that's really interesting to call out is why we didn't see worst decrease in revenue was their ad delivery across the family of apps was up 17% year over year. So if you're on Facebook, if you're on Instagram, you're seeing 17% more ads this year than you did this time last year. But the price per ad decrease was 18%. So they basically just said, okay, we're getting less money per ad. So you know what we're going to do? We're going to swarm you with more ads. And even in that context, they're still down 50% in net revenue. So sorry, net income. That's a pretty big flashing red sign that this is a dangerous place to be as a business. And we'll explain about why. This next paragraph is a pull quote, and this explains what's going on here. Reality Labs expenses are included in our total expense guidance. we do anticipate that Reality Lab operating loss in 2023 will grow significantly year over year. Beyond 2023, we expect to pace Reality Labs investment such that we are achieving our goal of growing overall company operating income in the long run. Okay, so where's all the money going? He's plowing it into the metaverse, and we've talked about that a lot. Okay, so I guess we have key takeaways. Revenue is flat, costs are up, profitability is meaningfully down. This is a reversion of a decades-long trend. The stock got hammered after earnings, down nearly 25% in a single day, largest drop in near-term history. And Meta is feeling the heat. And this is fresh off the presses this morning. Zuckerberg's message to Meta employees, quote, "Today I am sharing some of the most difficult changes we've made in Meta's history. I've decided to reduce the size of our team by 13% and let more than 11,000 talented employees go. And basically they're going to become more leaner and continue hiring freeze through Q1. So, wow, what a freaking bloodbath for the previous giant. I mean, more, I'm sure you have thoughts here.
I actually haven't seen that 11,000 number yet. Is this the biggest? I guess Twitter, Twitter said hold my beer, like with their numbers. But I mean, it makes sense. I mean, we talk about this every week, but to quote Zuckerberg himself, like, Senator, we sell ads. And there's basically two customer profiles for those ads. There are brand buyers, brand, which we cynically use as a shorthand for people who don't measure the efficacy of their advertising. And advertising that's not directly driving profits is one of the first things to be cut when economic times get rough. If you can't directly tie revenue to something, it's going to be high on the list for potential cuts. So that has been hit hard in the macro conditions. At the same time, as we talk about every week, they got hit with the privacy hammer and scan from Apple, which killed the largest portion of their performance buying, the other set of advertisers, which are largely focused on mobile. So you have the 1-2 punch of what is essentially like their sole revenue stream, and we're just seeing this, fully realized. I think with each quarter that has passed since these changes happened and since the macro conditions started worsening, we're seeing this get worse and worse. And I think now we're at the level of fully realized impact.
Yeah, and I think that's all right. And the other thing that they're doing is saying, you know what? And Mark Zuckerberg can only do this because he has, oligarchic control over the stock, and specifically the super voting stock. He's saying, and you know what? On top of that, I don't give a crap what you guys think. I'm going to continue to invest in money-losing projects at an accelerating pace. And so this is what happens.
I mean, one thing I would say is Meta definitely has the reputation of one of those rest invest type of companies that will defensively poach talent so it doesn't go to their competitors because their profits were so high. I think, our heart goes out to, folks impacted by this. Side note, we're hiring at Upptic. If you work in UA or creative or data science, feel free to hit us up. But I don't doubt whether these people were talented or not, that there was some fat or redundancies in these teams. That's been clear in our interactions with Meta and just from discussing from people that have worked there. So I think it's probably a healthy cut, as sad as it is for the individuals affected. And to be honest, I'm kind of glad to see them. To me, it tells me that Zuckerberg truly sees something and sees a path for success with metaverse. I'm actually at these price points, this is the first time I'm seriously, bullish on Meta. But relative to it's completely annihilated valuation.
Stock price, yeah, that's interesting. The question in my mind, and I think I generally agree with your premise. If I had a bucket of money, you could do worse than buy Meta stock now. Although the thing I would look for is what is a catalyst to unlock growth of that stock again? Because
there's no hurry. There's no hurry. I think
the current rates, it's just what they're doing is they're not handing back money to the shareholders. There's a long topic here about that you could go into about how Apple became a dividend payer and what that did for their share price. And Facebook is not doing that. And there's a way potentially, if they were to say, hey, instead of invest also this metaverse, become a dividend payer, potentially they could have a comparable impact to their stock price, basically be higher than where they are today. And he's taking the opposite tack. But I think the thing that's really, really concerning is the fact that by all metrics, the Reality Lab segment is not putting out anything that is functionally usable. Their DAOs are down. And there's reports people inside the company not using it. Now, this is all speculation. I don't actually have a good, clear visibility into it, But generally what you do is you invest in projects that are working. And, for instance, the iPhone was developed R&D with a $3 billion budget. He's planning on doing 25, call it between 20 and 25 billion a year for the foreseeable future on this project. And it's like, if you can get the iPhone, the most successful consumer product of all time, for 3 billion, I mean, you really need a tighter feedback loop. And that's the thing I'm scared about in terms of being a shareholder. It's like, where's the feedback loop here? It's clearly not happening for the next couple of years. So we'll see. Facebook is still an incredibly strong operator. But there's still big question marks in my mind. Okay, on to the next one. We're talking about Alphabet. Here's a quote from their earnings report. We're sharpening our focus on a clear set of product and business priorities. Product announcements we've made in just the past month alone have shown that very clearly, including significant improvements to both search, cloud, powered AI, and new ways of monetizing YouTube Shorts. We are focused on both investing responsibly for the long term and being responsive to the economic environment. Okay, so what does that mean in terms of their profits or revenue? Quarterly revenue is up 6% year over year to 69 billion. Net income, this is important, was down 24% to 13.9 billion. Search revenue was up 4% to 40 billion-ish. YouTube was down 3% to 7 billion-ish, and the rest of their ads products were effectively flat. So what does that mean? In aggregate, their growth is effectively non-existent in a way that, which is comparable but not as bad to what we saw on Facebook. So all that is to say is, even the leading juggernauts in the advertising space are not insulated from the retrenchment in the advertising business. And if anyone has a capability of weathering the storm from an advertiser's perspective, advertising business perspective, it's obviously Alphabet. And their stock's off 10% since the earnings call. Warren, what do you think about this, and how does this compare to what you're seeing within our portfolio?
Yeah, so the thing I really agree with is that Alphabet is the best defensively positioned, primarily through, you just look at the diversity of their revenue streams. Like we're going to be touching on Snap in a bit when we talk about Meta, when we talk about Snap, and some of we're not covering our earnings for ironSource and Unity on this episode, but it's essentially all from ads, for these other businesses. So being more diversified revenue stream, but still being ads juggernaut, I think, I saw an interesting graphic that showed that like a lot of the layoffs from these other companies, like Alphabet has been the biggest place where these people have landed by percentage. So I do think that, even though that, their numbers are pretty bad as well in a number of ways, I do think that they are going to make it through this in a healthier way than a lot of their competitors, which, we might see some other really crazy acquisitions over the next year or so with the level of like impact that these companies have had through, all these issues affecting the advertising market. Yeah.
And Alphabet is also, they're cognizant of their position in the ecosystem. And here's a quote from Business Insider entitled, "Alphabet is ramping up scrutiny of all its projects and cutting hiring in half as it tries to curb its cost." Really, really short quote. Alphabet is attempting to tighten its belt after going on a bit of a hiring spree. Sundar Pichai, CEO, said the company would review all its projects, quote, pretty granularly and, quote, make course corrections. So all that is to say is, while they're not doing layoffs yet, they are cognizant of their spend and they are decelerating hiring, which makes sense for a company in their situation. I mean, I think this is less existential for Alphabet than it is for Facebook. At the end of the day, they own Android, which is obviously they'll always control distribution of that no matter what happens to iOS. They have they're basically the biggest search provider, one of the biggest search platforms in the world. One of the biggest advertising platforms in the world, obviously the biggest search platform in the world. On top of that, they make about $7 billion. Wait, hold on, where's this number? Yeah, about $7 billion a year from their cloud services. So that's their version of AWS. And that is a growing segment that has nothing to do with advertising. And so that is, they are well better diversified than Facebook is in a really meaningful way. And so, Alphabet is, regardless of the short-term turmoil, Alphabet is very well positioned over the long term in a way that Facebook potentially is not if they get crushed in the metaverse going forward.
Yeah, well put. Who's next?
Okay, this one is we'll do kind of short because I don't actually have a ton of hot takes, but Snapchat. Here's an earnings quote. This quarter, we took action to further focus our business on 3 strategic priorities: growing our community, deepening their engagement with our products, re-accelerating and diversifying our revenue growth, and investing in augmented reality. So in terms of their numbers, their quarterly revenue was up 6% to 1.1 billion. However, net quarterly loss increased 400% to 360 million. Yeah. And they authorized a $500 million buyback program. On the product side, their daily active users were up 20% to just over 350 million, 360 million or so. So this is on the back of a 20% layoff of its workforce that happened in August. So that some of that should be captured in this quarter. But the serious increase in operating loss is an incredibly big flag. And Snap blamed in the macroeconomic conditions, but I think the elephant in the room is still ATT. And they were always the slowest to respond to Apple's ATT. And it seems clear that they don't have a cohesive strategy for how they're going to continue to make money, or to continue the path towards profitability in this post ATT environment. It seems like a company that still seriously needs right sizing. These are some of the craziest operating loss accelerations I've ever seen. And I guess we'll see in Q4 how the headcount cutting actually is reflective in the numbers for Q4. And that should give us an indicator of whether or not we think Snap has a chance going forward. I mean, obviously, so Snap's not can disappear. It's a valuable set of users. But if the price of the stock gets hammered enough, it becomes a really tasty acquisition target. Anyway, Warren, what do you think here? How does this line up with what you're seeing both like in macro trends and in the portfolio?
It's going to be a broken record here. I mean, you've got a business whose, I guess in this case, Snap is entirely mobile driven, right? Yeah. So they're going to, of all these entities we've talked about, they're going to be the most wholly impacted by these changes in the mobile advertising ecosystem. And I mean, just going to play the hits again. Everyone's spending less, like they can't buy profitably on iOS. Budgets are being cut overall. Inability to raise new funds for companies that aren't profitable yet. And there's just less buyers in the market too, as more companies, like just gaming companies, going under. And I know we're likely to dig into some gaming company earnings in a future episode, but everything is just lining up. If you can be up 20% in daily active users and still have to cut 20% of your workforce, then it definitely says that there are factors outside of your direct control likely impacting the situation.
Macroeconomic, Warren. I don't actually believe that. Can I interest you in some Snapchat spectacles? No? What about a drone? No? Okay. All right. Anyway, moving on. Apple, the elephant in the room. Apple's quarterly earnings report. This quarter's result reflected Apple's commitment to our customer, to pursuit of innovation, and to leaving the world better than we found it. As we head into the holiday season with our most powerful lineup ever, we are leading with our values in every action we take and every decision we make. We are deeply committed to protecting the environment, to securing user privacy, to strengthening accessibility, and to creating products and services that can unlock humanity's full creative potential. Man, what a great...
This sounds great. All of that sounds great, Xander.
Yeah, well, and to be clear, whether or not, we can talk about their spin in a second, but they are delivering in a way that nobody else is. So profitability, quarterly revenue was up 8% year over year to $9 billion. Product sales were up 9% to 71 billion, and services revenue was up 5% to 19 billion. And then their quarterly net income was effectively flat at around 20 billion. This is, they're very, very good at managing their P&L so that they are never making money. So some key takeaways. Apple stock spiked after earnings, but is now down 6% because the market continues to slide. Apple is a shining star amongst the big tech companies in that they continue to eke out profits. However, their profitability is still largely tied to their ability to produce high profit margin hardware, and their ability their profitability also marginally is now being levered to their ability to extract value from the ecosystem in the form of their services hardware, which is basically, services segment, which is their tax on the App Store, more or less. It includes some other things as well, but that's the big piece of it. So curious your thoughts here. I have some other thoughts here, but Warren, I mean, what do you think about Apple and how it stands out compared to everything else?
So most of the growth came specifically from hardware. This is what they're stating.
Well, they grow both. They basically break it out into two segments: services and product sales, which is hardware. And product sales were up 9%, and services are up 5%. So both growth in both segments.
That's interesting. I'm wondering. I'd love to go a little deeper into the results and understand what drove services up, because we know that that mobile gaming and mobile apps revenue is generally down.
Well, they don't. I would love to too, but they don't tell you.
Yeah, fantastic.
I mean, and to think about what else they have
mm-hmm.
in that bucket. I mean, it's everything from your subscription to the Genius Bar and Apple Care,
right,
to Apple Music, which I'm told is continuing to gain ground,
mm-hmm.
to Apple Arcade, and then on top of that,
Well,
all
they're
the
bundled subscription of Apple
Apple
One.
TV,
Mm-hmm.
Apple One, Apple TV. So there is a lot of value that they're still able to incrementally extract from their user base. And specifically, it's because they have the platform distribution advantage. They can push all these different subscriptions onto people and continue to make money there, even as by all indications, their iOS IAP revenue is being squeezed due to the changes made by ETT. I mean, 5% is not a lot of growth for a company that was growing a lot faster.
Apple, I'll give you a freebie here. How you can make your numbers go way up. So just play nice with Web3 games. So if you actually develop policy where you don't take 30% of every NFT purchase, but instead treat it like a marketplace and take a percentage of the marketplace fees, that will open the door and encourage all of this massive development funding that we've seen going into Web3. It will encourage them to prioritize launching on iOS, which a lot of developers right now are actively avoiding because of the current policies. So if you really want to diversify that revenue stream and really own another segment, like that's the play. But yeah, I mean, I'm being slightly sarcastic, but definitely Apple is going to be the last pillar to fall. They have a lot more income streams, similar things to what we said about Alphabet and Google, that we're not seeing the same level of impact directly to them.
Well, one thing I will say is they've made money because of their ability to produce hardware. Now, I don't know if you've been following what's going on at Foxconn, but right now, that segment of the world is under zero COVID policies that are demolishing that section of the world from China. They're shutting down. People are quitting, jumping the fences, and walking 200 kilometers home. I don't know exactly what that is in miles. If they cannot produce hardware, we are going to see the same destruction of the value of the stock, and they can't sell enough hardware into Q4. We're going to see the same damage to the stock that we saw everywhere else across the tech ecosystem. And this is one of, they say they're good, they're doing what's best for humanity, but they're still using, very low cost labor and very poor working conditions in China to produce the majority of their hardware. So despite what they say, I think we have to look at this with clear eyes and understand that, like, we'll see. They're not out of the woods yet. So anyway, that is our wrap up of the earnings we're going to cover for this episode. Obviously there's more, but we can't get to everything. We're planning on doing another breakout episode specifically on gaming's earnings. So if you're interested in this kind of stuff, stay tuned for that in a couple of weeks. There are a couple other things that we could call it here. Warren, do you want to touch on these next couple of things?
Yeah, I mean, I think, it's just like a postscript for Apple. Like there is rumors of an Apple hiring freeze as well. So just a quick pull quote from Business Insider on this. Apple will freeze hiring, according to a report from Business Insider, and the hiring pause could last for months or nearly a year, according to 3 unnamed sources who told the publication that the decision will impact the company's full-time forward employees. Business Insider notes that the company made the decision due to current macroeconomic climate. And then there was another recent announcement to piggyback off of this of Amazon with an internal announcement about a hiring freeze. So to read that really quickly. With the economy in an uncertain place and in light of how many people we've hired in the last few years, Andy and S team decided this week to pause on new incremental hires in our corporate workforce. We have already done so in a few of our businesses in recent weeks and have added other businesses to this approach. We anticipate keeping this pause in place for the next few months, and we'll continue to monitor what we're seeing in the economy and the business to adjust as we think makes sense. And then everyone knows about the massive Twitter layoffs as well. So it is a tough time to be working in big tech right now.
More is my job.
Yeah, you're looking good, Xander. I mean, the secret of Upptic, not to get too shilly, is like we built a business where we really try to focus on clear, measurable profit driven by our work. And I think, this is a period where there's a lot more eyes and scrutiny on, all parts of, any cost source, right? And not that Upptic is impervious for it, but I think, when any business is doing an audit of where their cost is going, they're going to try to tie it to, can I directly, tie this cost source to revenue? And, not that we, aren't at risk or don't make mistakes, but just having a business that is built around delivering clear and measurable revenue and profits for the games we work on, I'm hoping for all of our sake gives us a little defensiveness here, but we'll see how this pans out.
Awesome. So we'll go to a quick app of the week section as a roundup. And Warren, you want to start?
Yeah, I'm doing a little bit of a bundle this week, and the theme is apps to store your money in during troubled times. So I think we've touched on at least a couple of these, but the three that I kind of keep tabs on and will move my own funds around on are BlockFi, which you touched on earlier, Gemini, and Robinhood more and more. So I just wanted to do a quick kind of roundup of these and updates. So for Gemini, they've been like lowering their rates a bit over time. It is tied to their native stablecoin, and that's also
coin.
Yeah, exactly. And similarly, BlockFi, their earnings are tied to stablecoins. They do provide interest on a number of stablecoins, including Binance's BUSD and the Gemini GUSD, as well as USDC and Tether. So both of those currently have, call it like between 5 and 7% variable interest rates. But with them, you have the risk of stablecoins. And, looking at the last year, like definitely, it's a cost benefit analysis, but definitely don't rush to put all your funds in that. And we've covered this before, but I'm giving an update. Robinhood has been going ham with offering interest on holding your cash in Robinhood. We reported that they started offering 3%. They just bumped it up to 3.75%. Oh. And, I think there's maybe an unproven risk of how they're generating those returns. It is not stable coins. It's tied to
government bonds. They have 9% government bonds. You just take your cash, go buy 9% bonds.
That's true. It's tied to what they call like a cash sweep system, which I think has to do with stock lending. But again, I'm not an expert there. Xander, if you have insights on how cash sweeps work, but I think it's just interesting, and I do think this is going to be an interesting conversation in current macro conditions of like, hey, I just want to hold on to my cash. Like, where is the safest place to put this? So I thought it was worth just doing like this roundup of, the apps that I think about for just like holding cash and generating returns on that.
Yeah, and from my perspective, I have Robinhood, have a lot of stocks in Robinhood, and then I have BlockFi, and I hold both my Ethereum. The majority of my Ethereum and Bitcoin, which is not being used for, say, NFTs in the short term, that all sits in a BlockFi account earning nominal interest. So it's like 3 or 4%, which is actually better than a lot, although you're losing it on the depreciation of the asset.
Right. And I forgot one of the reasons why I wanted to touch on this was, BlockFi was like a leader in the segment. For the last year or so, they actually haven't been allowed to take deposits for their interest generating product. And they just made an announcement this week that they're about to open it back up, but only for accredited investors. So you basically will have to prove you're an accredited investor. If you do, they have the current highest advertised rates of these three, which I think is about 7% for stablecoins, or 7.5. So that door is opening back up. But going back to the top of this episode, I think you need to think of the innate risks with stablecoins. And if nothing else, I'm waving a flag that like, if you use these products like BlockFi and Gemini, you have something that looks like cash. It's not actually cash. So make sure you do your research and understand the risks associated with that.
It's a good note.
Yeah. Xander, what do you got this week?
I have kind of an interesting niche one. I'm talking about a Steam game called Victoria 3. Now, Victoria 3 is a paradox game, which is basically a simulation of the global economy from 1836 to 1936. And it is the nerdiest game that you can possibly play. You think magic is bad? You should try playing this game. You basically take control of a country and you guide their economic development through the Victorian era. And it is literally like playing a spreadsheet, but if you are somewhat of a nerd, it's quite a bit of fun. And what I really, really appreciate about it is the fact that it does, I think, the best job of any game I've ever seen in terms of articulating economic theory and economic models in a easy to ingest way to play. So basically you can learn about real economic theory through playing the game. And that is something that I think, you know, as someone who is really bullish on game segment as a whole, one of the things I really appreciated about it is the way that allows you to learn in ways that books or any sort of other engagement period don't, because you act out different economic theories and then you see the impact in game mechanics. And that is the best out of anything ever, I think, well, except for like maybe running a country, to understand the impact of different economic theories in the real world. And so deep hole, I mean, you're not going to understand the basic mechanics until you play about 40 hours. So risk associated with this is you lose a bunch of time, but very, very good simulation game if you're at all curious in that sort of stuff.
Awesome. And that's on Steam?
It's on Steam. I think it's probably elsewhere, but I play it on Steam. Cool. Well, that is our earnings wrap up episode. If you want to hear more of this, we'll have some on gaming in a couple of weeks. Warren, do you want to take us out?
Yeah, that was fun, Xander. It is a crazy time to be alive and working in tech and games and growth marketing. But that's what we do here at Upptic. So, you know, at Upptic, we do all things to help games grow, both providing the technology infrastructure, some really cool tools around measuring scan and optimizing your iOS spend. It's been something we've been really focused on and utilizing for our clients lately. But we do all things to help games grow. And if you need help, and a lot of people do need help right now, we love meeting developers, just talking through your problems, seeing where we can add value. And you can reach us at upptic.com. That's upptic.com. Thank you, Xander, for the earnings analysis. And we look forward to seeing you all next week.
Awesome. Talk soon.